topic for this month is negative gearing. Everyone nowadays is wondering how to do negative gearing. Negative gearing has been a buzzword for quite a long time. Some people are opposed to negative gearing, like our governments, our ATO systems, and some people love negative gearing, such as rich and famous. So let's look at what negative gearing is. Before you take a dip in the deep waters, know what you are getting yourself in. So, what is negative gearing? Negative gearing occurs when your expenses from investment properties are more than the rental income earned. So, basically, you have made a loss on your rental property. What is positive gearing? Positive gearing, as you have guessed, occurs when your income from your investment property is more than the rental expenses incurred. So basically, you have made a profit on your rental income. What gearing should I do? So this is a very important question because it will depend on your wealth goals. A lot of people do negative gearing to reduce their taxable income so they can get a big tax refund back at the end of the year. So the question you will need to ask yourself, is negative gearing right for you? Is it wise to lose money to gain some tax advantage? Everyone's situation is different, so you will need to assess your situation according to your taxable income and what other profits and income that affects your tax return. Let's break some of the negative gearing myths. The very first negative gearing myth is you can only do negative gearing if you are earning an income of 180,000 or more. There is some truth with this statement, but not always only higher income can benefit. And very soon we will look at an example of higher income negative gearing and lower income negative gearing. And you will be able to see the difference between both income scales. The second myth about negative gearing is to have a good negative gearing, you need to have only interest-only loan. There is some truth to that because the higher the interest, the higher the deduction. But that means that your principal won't be paid off. So it's kind of a balance that you will need to get, whether to pay higher interest or have a principal and interest only loan. The third myth that we have, and which is a very interesting one, because ATO has made recent changes to this particular type of deduction to reduce people from doing a lot of negative gearing. And the myth is that depreciation is very important when negative geared. Yes, it is, because depreciation is a non-cash item. So basically, you are not paying to get the deduction. It is basically depreciating on your assets that you have already bought. Now, the rules for depreciation, as you all know, changed on May 9th, 2017. And we will go through some of the depreciation changes very soon. So before we decide what negative gearing is, let's look at a practical example and see how it works on your tax return. I'm just going to switch the slides. So this is a basic example of how negative gearing works. So I have put that I bought a property on 20 Medibanong Street in Medibanong. The property is owned 100% by myself. If it's owned by husband and wife, or if you have shares with the other people, you can change the percentage. But for this example, today we are just going to say that I own the property 100%. These are some of your typical rental income and typical rental expenses. Rent received is basically the rent that you receive every month or every week. Other rental would be, say, for example, water rates paid by the tenants or some bond income that has come through. But usually there's not usually much other rental income. Some of the typical expenses for our rental income are advertising, cleaning, council rates, depreciation, which is the biggest one, capital works. Capital works is called building depreciation. So getting a building depreciation at either 4.5% and depending when the building was built. Insurance, interest on loans, land tax, agent commissions, repairs and maintenance, water charges, and other rental expenses. As you can note, on this spreadsheet, there are no travel expenses. And the reason is because ATO has taken travel expenses out as a deduction for rental property. So what that means is if you are traveling to inspect your rental property, either incurring airfares, taxi fares, hotel, it is now non-deductible. So you cannot deduct any travel expenses to inspect your properties. So these are generally our common expenses. So as you can see, the rental income is 21,000. Our total expenses are 52,000. Therefore, I have made a $31,000 loss on my rental property. Again, these figures are a little bit higher just for the practical example, but this will show you how it actually works on your tax return. So I have made a loss of 31,000. Let's look at income tax on higher income. So let's assume that I earned 120,000 from salary. I have some little deductions, work-related deductions, such as home office or training or whatever the small deductions that I have. My taxable income is 117,000 without the rental loss. And my income is still 117,000 with the rental loss. Now comes the rental loss. So if I didn't had a investment property where I was negative gearing, I would be paying a tax of 28,000 plus the Medicare levy of 2,350. And so the total tax paid would be 31,000. That's just adding 28,000 plus 2,350. Now we will look at how it changes when I do have a rental loss on my investment property. So the income is the same, the work deductions are the same, and the taxable income is same. So now the 31,000 that was just here has come up as a rental loss, which would reduce my taxable income by 31,000. So now my taxable income is 85,000. On 85,000, I only pay tax of 18,000 and a Medicare levy of 2%, which is 1,718. So my tax payable is 20,000. You can automatically see that I have got an advantage of $10,000. So if I didn't have a rental property, I would be paying a tax of 31,000. If I have a rental property that is making a negative loss, then my tax is 20,000 and therefore I have a tax advantage of $10,000. Again, this tax return is quite simple. There might be few other things, but for simplicity, we are just looking at the rental loss kind of part of how tax return works. So you can see that I have already made $10,000 tax advantage. Now let's look at income tax on a lower income. So as we discussed, one of the myths was that you have to be earning over 180,000 to get advantage of negative gearing. So now we are going to look at what happens if you do not earn more than 180,000 or you are not on a higher income stream. So the figures are still the same. So I have a salary of say 50,000. The work deductions are the same. My taxable income is 47,500. Same with the rental loss. On 47,000, I only pay smaller amount of tax, which is 5,904. Of course, there's Medicare levy of 950. So I pay tax of 6,854. I'm just going to get a sip of water. With the rental loss, all the figures are same. The 31,000 loss is coming. So my taxable income from 50,000 has been reduced to 15,000. As you all know, if you earn less than 18,200 in Australia, there's no tax. So I basically don't pay any tax, but I have got an advantage of 6,854. So the moral of the story is negative gearing will definitely help you with the lower income as well, but your tax saving will be lesser than what you were on a higher income. So this is simply how rental loss works on your tax return. So let's go back to the slides. And as I already have said, that the higher the salary, the better tax savings. And negative gearing done smartly with higher depreciation expense is better because it's not money actually coming out of the pocket. As I said, it's just depreciating what you have already bought or built. So like curtains, carpet, building depreciation, blinds. So you're depreciating something that you've already bought. So the important changes that we recently saw in 2017, where the government has punished some of the investors and trying to discourage overseas investors to come in and invest in Australia by taking out certain depreciation items that you cannot claim as a deduction. This was a major changes, and it played major role for some of our investors. Some were opposed in 2017 and some were for the depreciation, the new changes. I guess it all depends on how much gain you would get from the changes. So let's look at the 2017 depreciation rule changes. So one of the rules that was changed was you can only depreciate an asset that is new. Second-hand assets cannot be depreciated. This means your purchase will include newly built houses or substantially renovated house that was purchased within 6 months and no one resided at the property before you acquired them. So what does that mean? That means that if you have built a new house, like a land and house package, you will get depreciation advantage because that house has never been lived in. So all the assets in that house has never been used. So it is called a brand new assets. What does substantially renovated house means? You have to be careful with renovation. You can't just say that I renovated my house by just changing the flooring or just painting the walls. Substantially means you are actually changing the structure of the house. So either you breaking the walls, adding more rooms, putting a brand new kitchen, brand new bathroom. So the changes to the house should be at least 4 to 5 rooms has to be changed. 80% of the house needs to be changed before it could be called as substantially renovated. So be very careful when you are trying to do a renovation and thinking that you can get a depreciation advantage, because the meaning of substantially renovated means 80% of your house is fully renovated. Negative gearing with second-hand asset. So you can, as I've said, you can only claim for second-hand asset depreciation if you purchase the property before 9th of May 2017, or you installed an asset in your rental property before 1st of July 2017. The dates are very important because 9th of May 2017 is when the federal budget passed their legislation and these rules came in place. So if you want to claim a second-hand asset, you have to ensure that your property was purchased before 9th of May or the asset was installed before 1st of July 2017. Most of my clients always ask that if I want to turn my family home into rental property, can I claim depreciation? Well, the simple answer is if you turned your family home into rental property before 1st of July 2017, then you can claim depreciation on assets. Otherwise, no. However, you can still claim depreciation for any brand new plant and equipment that you purchased and installed in the property once it is income producing. So for example, in 1st of June 2019, in my rental property, I put a new hot water system and the property has been leased and earning rental income. You are entitled to claim for the depreciation because that new hot water system was never used by me as a homeowner. And it is definitely a new asset. This is also an interesting one because with the depreciation changes, ATO also passed the rule about travel expenses. And as I mentioned before, if you have a residential rental property, you may not be able to claim a deduction for travel expenses related to this property. Meaning if you incur airfares, taxi, hotel, or car expenses to inspect your residential rental property, this can no longer be claimed. Please note, these only relate to residential properties and not to commercial properties. So for commercial properties, if you own, you can claim travel expenses. So in Australia, we have two methods of calculating depreciation. One is diminishing value, which gives you higher deduction in early years of an asset. And the second one is a prime cost method. That is just basically same decline every year. So it would be 2000 for next 20 years. Which method to use really depends on your strategy or on your wealth goals. But most of the taxpayers would be using diminishing value method because it gives you higher deduction in the early years of rental property. This is a very interesting one, and this is the most audited deduction for rental properties. Most of us cannot differentiate between a repair and a capital improvement. So it's very important that you understand what a repair is and what is a capital improvement. So when you acquire the property initially and do some repairs, this is capital nature and will depreciate. So usually repairs can be deducted 100%. You do not need to depreciate. But if it's a capital improvement, then you need to depreciate over the life of the asset. So as an example, I bought the property today. And from tomorrow, I'm going to start some repairs like painting, changing a gas stove, putting a new oven. These kind of things are called capital because you have done repairs before the property started becoming income generating property. So any repairs done before the property earns an income, it is usually a capital nature. So as I said, it's very important to understand and distinguish between a repair and capital improvement, because those two items are heavily audited by ATO. Repairs are basically replacing the same asset with another same asset. So for example, painting walls is just repairs. If I have put if my Bosch oven has been damaged and I'm putting the same Bosch oven in the kitchen, it is repairs because it's item to item is same. While capital improvement is basically you're replacing the asset with better quality or standard of the asset. So for example, I had a wooden floor in my rental property and I want to put a nice carpet. So that is a capital nature because I have changed the nature of the asset from wooden floors to a carpet. This kind of deduction, it's always important to talk to your tax accountants, and they would be able to point out whether it's an whether it's in repair or a capital improvement. Another deduction that you saw on my example under the rental expenses was capital works. So capital works, as I've explained before, includes expenses incurred in building the property, as well as carrying out structural improvement, alterations, and extensions to the property. Capital works generally has been known as building depreciation. The rate of deduction for this capital work is generally around 2.5% or 4% per year, spread over a period of 40 or 25 years. This will all depend when the building was built, and the percentage will be dependent on the date the building was built. You can only claim capital deduction on rental properties built after 17th July 1985. Now, why is that date important? Because after that date, capital gains tax was introduced. So before that date, we do not have capital gains tax effects. So there is no depreciation write-off available. Negative gearing and capital gains tax. What does CGT stands for? CGT is capital gains tax that comes into effect when you sell an asset like a rental property. So capital gains tax can be incurred only at the time of selling, not at the time of buying. Capital gains tax can be on any of your investment property, whether it's shares, cryptocurrency, some of your personal assets that are more than $10,000. So if you sell any of those things for a profit, you may be up for a capital gains tax. Today, we are not going to touch base on capital gains tax, but the point I want all of you to be aware of is all the depreciation you claimed over the years of owning the rental property adds back as your cost base. A lot of people are not aware of this fact and may get a bit of shock or a big surprise when the accountants tell them that all the depreciation that they have claimed during the owning the property on their tax return, they all form part of the cost base. So what do I mean by that? So if you can look at my rental expenses. So if I'm selling the property today, if I'm selling this property today, So the property was bought for 500,000. The cost base would reduce by that amount. So now my cost base is 475. And if I sell it for 600,000, that's the profit I have made on my rental property. A lot of people don't add this in and they think they have to pay less tax, which is wrong. All your depreciation and capital works will be adding. See how the profit has gone up because we have reduced the cost base, which is the purchase price of the property, by 25,000. So it's very important to know that when you are selling the property, the depreciation that you have claimed over the years will be added back as a cost base. Soon we will be chatting about CGT, but I wanted to make sure that you are aware of this point so that it doesn't come as a surprise when an accountant or a tax advisor is telling you to pay capital gains tax. So this concludes our negative gearing workshop. If you have any questions, please feel free to either email it to us or put it on our private Facebook group, and I will ensure to answer them. Since we have done negative gearing and the biggest deduction for negative gearing is depreciation, we have a guest coming next Friday from BMT Tax Depreciation, and that the person will be covering all the bases of depreciation and why there is an importance on having the right depreciation schedule and what depreciation you can claim and what you cannot claim. So I hope you all can join me next Friday with our guest speaker, Chris, and she will be going through all the questions that we have compiled and will be able to provide a lot of value on why depreciation should be used to do negative gearing instead of having higher interest. So folks, I hope you all enjoyed this negative gearing workshop and you got some value out of it. We will be doing another topic next month, so be tuned. But in the meantime, if you do have any questions, please feel free to either email or put it on the Facebook, private Facebook page, and we will get back to you. So thank you.